to meet outside its scheduled proceedings to discuss its failure to keep inflation below 6%. That meeting is for tomorrow. It's going to be the big story tomorrow, and all eyes are on what the Reserve Bank will actually say. Now, we'll probably not know because it's privileged information, and the Reserve Bank has to, by law, explain to the Government of India why it has failed in its mandate to keep inflation, that's CPI, between 2 to 6% if that happens for 3 consecutive quarters. Now, that is the case over here, and they have to give their explanation within a month of failing to meet that target, which means looking at when the last CPI print was out, their deadline is 12th of November. Now, we all know that the RBI has been unable to keep inflation below 6% for quite some time now. It's been 3 consecutive quarters, but that is the situation the world over. In fact, inflation was at its 5-month high in the September print. What's also important, though, is the timing of this meeting, because it takes place a day after the FOMC meet. My colleague Ankur Mishra is joining me now to give us a preview of what we could expect.
Yes, all eyes on Monetary Policy Committee meeting, and expectations are that there will be no surprises in the outcome. We learned that under Section 45(ZN) of RBI Act, the Monetary Policy Committee will discuss the contents of the letter which it needs to send to government because it has failed to keep inflation under check. Remember, the Act mandates for MPC to keep inflation at target 4% plus minus 2%, meaning between 2 to 6%, and in this current year itself, for 9 consecutive months, the inflation has been more than 6%. In fact, in the last month itself, it was 7.4%. Therefore, MPC will have to explain the reasons why inflation was high, and it can give reasons like global factors because ever since the Ukraine war broke in and the commodity prices went up, and hence it could be one of the reasons which could be given by MPC for inflation being more than the target. Apart from that, the remedial actions will also be suggested by the Monetary Policy Committee. It will also suggest the ways which it is taking for keeping inflation under check. Remember, the Monetary Policy Committee in the last meeting had guided that inflation will soften after March 2023, and it can come below 5% after that, and therefore similar suggestions could be given to government. Now it is up to government whether or not to accept these suggestions or give some new direction to MPC.
The MPC resolution is meant for the entire economy. Immediately, the market should know what is the RBI's decision. Citizens of the country should know what is the RBI's decision. Unlike that, the letter in the case of a letter which which the Reserve Bank writes to the government, it's a report sent under a law. I don't have the privilege, the authority, or the luxury to release a letter like this, which is written under the law as per the legal requirement. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. There's so much of communication which goes on between the Reserve Bank and the government, both ways. We don't share each and every letter. But that is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point. So the limited point that I was making, and I don't want to be defensive about it because that is the legal position. I have no authority to just write a letter to government and then release it to the media. It's not like, in the political space, for example, there are leaders who write a letter to the government and immediately release it to the media. That is for a different purpose. Here, the first right of receiving the letter lies with the government. The addressee should get it first. In due course, sooner than later, it will be out. The Parliament will know about it. The Standing Committee of Parliament will know about it. It will be really, the contents will be known. So it is not as if there is transparency being compromised in any manner. And I want to say it very emphatically that the monetary policy framework instituted in 2016 is a very transparent framework, and the writing of the letter is also very much an essential and fundamental element of that transparency. Nobody is hiding anything from the public, but it's a question of time.
All right, the suggestions and the remedial measures is actually what would be most interesting to see. Maithili Bhusnamat, consulting editor, ET, now with me on the show now. I'm speaking with Indranil Pan, chief economist, Yes Bank. Welcome to both of you, and thank you so much for speaking with us today. Maithili, this is an unusual development. I mean, it's not surprising, I would say, because the world over, there's high inflation levels. But this is an unusual development for the RBI because they actually have to, as per law, write an explanation. What do you think that letter will look like?
Well, Tamanna, this is slight clarification I think one must start with, simply to say that this is not really that unusual a situation, because in 2020 also, the Reserve Bank of India had exceeded that 6% for 3 consecutive quarters. But then they bought time basically from the government with the tacit approval, I would say, of the government, really by saying that the inflation numbers during the COVID period could not be relied upon. So this is a letter which perhaps should have been written 2 years ago, but that time there was this excuse that the RBI propped up, and the external members also didn't raise any objection. The public at large was also willing to give the RBI some rope, and so no questions were raised. But now it is once again, it is the second time really that we've crossed that 6% mark for 3 consecutive quarters. So the RBI has to submit the letter, as you had said, as mandated by law. So what is the RBI likely to say? We'll never know for sure. Today the governor at the FICCI meeting did say that the contents would be made public subsequently. He didn't specify exactly when, but he said at the time of writing, it's up to the addressee, that is the government, to decide whether it wishes to make it public or not. So this is contrary to what happens in the case of the Bank of England, where these are called open letters from the governor to the Bank of England, Chancellor of the Exchequer, who is the equivalent of our finance minister. So what is the letter likely to contain? Well, the usual reasons that the RBI has been telling us after each MPC: COVID, supply disruptions, the war in Ukraine, high oil prices, the rupee depreciation, dollar appreciation, so all of that. So what would be more interesting would be if and when we get to see what are the proposed measures that the RBI intends to take, and by when do they expect to get inflation back to that 4% mark. So those are questions to which we really are awaiting the answers, but maybe we'll have to wait for a little longer to see that they knew that the RBI can tell us that it hasn't told us so far, because they told us all these reasons. They've also said it'll take about 2 years. Sorry, long answer to your question, but I'm afraid that's it in a nutshell.
All right. So 2 years ago, what I found interesting from that, and I'll come to Indranil on it, is that 2 years ago, they could say that, yes, COVID-19. And that was understandable, unusual time. We also went in for lockdown, etc. Can they still talk about post-COVID impact today? Or is it all the US-Russia war, global supply chain, etc.? Short question, how long or how far will that COVID reasoning go?
I think at the current juncture, I don't think it's the COVID that is really playing out for the inflation, at least for India. Now, very briefly, I think the type of inflation that US is seeing at this point in time is, according to me, different from the type of inflation we are seeing. In India, we still have a very significant share coming from the food component, and inadvertent weather conditions, excessive rain in certain parts of the country is likely to have damaged the paddy crops also, and that could have its implication for inflation. Now, most of the data that I was looking at for October, it is the spike in the vegetable prices once again that might keep inflation on the higher side. And I am very afraid to say that monetary policy alone may not be able to contain inflation at this point in time. To a certain extent, it also has to be a fiscal containment along with monetary containment that will possibly break down inflation. Now, what I really mean here is that the monetary policy can sort of shrink. But if we have the fiscal deficit being higher than the target that has been set out, mostly because of the higher subsidies, that to me is to a certain extent also an expansionary fiscal policy, even though fiscal deficit as a proportion of GDP may not likely to be higher than the 6.4% that has been set out. So all this taken together, it will be a difficult task for any central bank at this point in time to contain inflation. Our own models indicate that a sub 6%, which is the first thing that the RBI should be looking at,
Right.
would be as dragged as in February 2023 than immediately.
All right, so it'll take some time to go to the sub 6%. Now, coming to the question of the remedies, Maithili, the RBI has already been hiking rates. And that's not necessarily working when it comes to, if I look at the target of below 6%, which is the mandated target. So what more can they do? Do you think it's even likely that they will talk about making those rate hikes steeper? What are those remedial measures?
Tamanna, the problem with inflation is that it's very difficult to tackle once it sets in and once inflationary expectations get entrenched, which is why inflation is often compared to squeezing toothpaste out of a tube. It's very difficult to put it back. And though all the points that Indranil said are true of headline inflation, the fact is that core inflation, that is what is within the mandate of RBI's monetary policy, that is inflation excluding food and fuel. That means those parts of inflation that are purely within monetary policy mandate, that has also been over 6% for close to 3/4. So here I'm afraid the RBI will have to take some of the blame, not all of it, because the fact is that the RBI eased monetary policy big time at the start of COVID. It was necessary then, but what it failed to do is roll back sufficiently early because it was worried about that the economy would collapse. So it kept monetary policy loose for longer than warranted, and today we are paying a price for that. Of course, the Ukraine war didn't help matters, the appreciation of the dollar didn't help matters, but the fact is that the RBI must accept some of the blame for not rolling back the excessive liquidity in time. Unfortunately, once that happens and inflation gets entrenched, there is really very little the RBI can do, because beyond a point, if you keep hiking interest rates, it does hurt growth, which is why the West, especially your US, is worried about recession hitting them, because as the Fed continues to hike rates, and today we have a Fed meeting there where the Fed is likely to hike rates again by 75 basis points, it will hurt growth. The question is, what more can the RBI do? Frankly, not very much, which means pain for all of us. The government can help up to a point, but things like subsidies, etc., they come back to haunt you later. So the RBI must share some of the blame, if not all of it. So that is what I think is going to be missing in the letter. The RBI needs to do some soul searching and accept that part of the blame lies at its door as well.
Indranil, your response to that. Could RBI have, reduced the liquidity at some point? Could it have acted fast? And all of these fiscal moves that you're talking about, is the government in a position to actually roll some of them out?
The second part of the question is very difficult to answer. And to a certain extent, obviously, because of the COVID hit and the hit being much more disproportionate for the lowest segment of the population in terms of the income classification, you needed to give out subsidies, or you needed to give out free food over there. You needed to arrest the rise in the input cost for the agriculturists by sort of providing additional subsidies for fertilizer. So I'm not doubting that all of that is needed. But having said that, the point that I was trying to make is that there has to be a much better sort of calibration of the fiscal. For the last 2 years, we have had sort of the higher inflation leading to higher taxes. And now, if you are trying to reduce the prices, your nominal GDP growth obviously will be relatively lower than what it is today, and more in the trend path of 11.5% to 12%. And that is what the central government needs to be very carefully looking at. Now, coming back to the RBI, I'm not sure whether it's directly we need to blame the RBI, because in today's sort of the FICCI speech of Dr. Shaktikanta Das, he also clearly explained that the unfortunate timing of the Russia-Ukraine crisis, when we were just coming out of the COVID, and therefore our growth cycle was not strong enough, and there could also be some deadweight loss that we are carrying. It is very difficult for the RBI to have raised rates aggressively at that point in time. So that's one sort of part of the story. The other part of the story, of course, is that there is as Maithili also explained, the food inflation being on the higher side also sets in motion the inflationary expectations, and that's what the RBI is possibly trying to address at this point in time, rather than trying to sort of bring inflation or even the headline inflation down towards the 4%, which has been the sort of the noted anchor, even though various RBI people did try to explain that they operate within a flexible inflation targeting mechanism.
So let me ask, of course, we'll wait and see what happens with the letter tomorrow. It's unlikely there'll be a rate hike with the MPC meet. There'll be a letter, but another meet scheduled soon. So are we going to see more rate hikes? Indranil, what's your take on that?
So obviously, I think it's no shying away from the fact that we need more rate hikes. We need more compression in demand, because as I was explaining, that the fiscal sort of enhancement also means that there is demand that is pushed in the economy. So to that extent, the monetary policy therefore needs to be tighter than otherwise would have been. The other factor also is that in this cycle, emerging market economies possibly need to follow the global advanced market economies and their central bank action more closely, because the direct hit therefore comes on the capital flows. So if the interest gap between the India and US, which is anyways quite low at this point in time, is allowed to shrink further, we may actually see further erosions on the capital flow, and therefore a balance of payments issue, and hence larger FX sales by the Reserve Bank of India. So all that taken together, we are continuing to pencil in a 50 basis points in December, and possibly a 25 to 35 basis points also in February. And beyond that, I don't think my human eye can figure out. It depends a lot in terms of data. It depends a lot in terms of how the global central banks are moving at that point in time.
Absolutely. We can't predict too much beyond a point. Maithili, is that sort of the general consensus?
Well, if you see what the Reserve Bank of Australia has just done, they have hiked rates, but by less than what they used to hike in the past, even as they hike their inflation projection higher up. So I think the Reserve Bank also might perhaps continue to hike rates, but not by 50 basis points, maybe by a little less. Because as I said, hiking rates beyond a point doesn't really help anybody. And the Reserve Bank knows very well that monetary policy acts with a long lag. So whether you hike by 50 basis points or not, it's going to be at least another year before you get inflation back under control. So I think there might be a case for the RBI hiking rates, but trying to kind of talk down inflation in a way a little bit, and maybe there's a case for a 40 basis point hike.
So you're saying another year before they get inflation under control. Indranil talked about Feb till we hit 6%.
Well, yes, I think it will take
time. Indranil, did you mention Feb? Did I get that correct?
I did mention Feb. So the point is that instead of the 4%, which was the central anchor, the RBI should be happy if they are able to first get it below 6. So that's what I was trying to mention.
When you're saying under control,
please continue.
When you're saying under control, you're saying under 6 by Feb. When
under 6 by Feb.
When you say under control, Maithili, are you also talking about under 6?
No, not at all, because the target is 4 plus minus 2%. So you should be looking at 4, not at 6. 6 is only in extreme conditions, just as 2 is also in extreme conditions. So I would look at the target as 4, in which case it will take about 2 years. In fact, this is as per the governor's own admission, I think in a policy statement, I think the previous or the one before that, he said it would take about 2 years for the RBI to get inflation back to 4%.
So the pain of inflation is going to be around for a while. It'll be interesting to see what finally comes out in that letter, because the promise is that it will be made public eventually, and that is something which will need more dissecting. But for now, thank you so much, Maithili and Indranil, for joining us on the show today.